much, James. Thanks very much for asking me to be a part of this. So yes, I'm Natalie Kenway, Global Head of ESG Insight at ESG Clarity. I'm delighted to be opening the Quota Data ESG conference, which, as James said, we're running over the next 3 days, providing you with insights, opinions, analysis on the evolution of responsible investing in the investment trust world. Over the past few years, the pace of adoption in terms of integrating ESG into investment and savings portfolios has been phenomenal. At a time when funds and markets have seen outflows, those with higher ESG credentials have seen inflows. And this absolutely applies to investment companies as well, where the number of trusts investing in environmental firms or social impact solutions has grown from just a handful to well over 30 vehicles. And there are some 13.4 billion in assets under management in the renewable sector alone. With recent research from the AIC shows that while some private investors care very much about ESG, it is quite far down the list of priority factors for many of them, and there is still a lot of confusion around different funds' ESG claims. For example, 57% of those surveyed by the AIC said they continue to prioritise performance over ESG, and another 57% said they find ESG investments harder to research. So this is where companies like Quoted Data and this conference can play an enormous role in providing investors with the insights and tools needed to further understand and embed ESG practices into portfolios. I have recently returned from COP26 in Glasgow, where there were a number of, some would say ambitious, some would say not, commitments announced. But one huge factor that I took away is that the investment industry role, and so one huge factor that I took away from that is how huge the investment industry's role is in all of this, and how that we are urgently being directed towards playing a leading part in the worldwide transition to net zero. So just to recap some of the headlines from Finance Day, some $130 trillion from asset managers were committed to transition into net zero by 2050. That equates to 40% of the world's financial assets from 450 firms across 445 nations. There is some skepticism about this, and especially around the details and where there may be overlaps, but us in the media will be carefully monitoring those. And I have to say, I did feel like I left COP26 with the sense that the pace of change we have recently seen is nothing, and it is only going to accelerate from here, with COP, net zero and a just transition dominating our conversations for some time before ESG is part of mainstream investing. So on that note, I would like to introduce our expert speaker. Joining us this morning is Julia Dreblow, SRI Services Director and founder of Eco Market Fund Tool, which has the core aim of helping investors to build SRI and ESG options into their advice on portfolios. She brings a wealth of experience, having been a sustainable and responsible and ethical investment specialist since the 1990s, and her work includes consulting, speaking at events, media, and in her words, loosely banging the drum to encourage the shift to a more sustainable future. Julia, thank you so much for your time. We have certainly been busy over these past few years in our neck of the industry, and it only looks like it will accelerate from here. Are we ready?
I am here, Natalie. Can you hear me okay? Let's check.
Yes, I can hear you.
Fantastic. Well, first off, thank you for inviting me. And Natalie, I'm looking forward to this discussion immensely. This is a really good way to open up the kind of conference that frankly we wouldn't have seen a few years ago. So it's exciting. There's all these people getting involved, and this kind of thing gives me hope. We can do this. We can actually address all these environmental and social challenges that we've got to if we get investors behind. And that started just as you were saying in your introduction. So thank you.
Yeah, thank you very much. So as we know, you're looking at the ESG fund universe all the time, and it's vast and growing. How do you approach the various, analysing the various moving parts we have in the responsible investment industries? For some, it can seem quite daunting, the number of products we have out there.
Yeah, thank you. It does terrify people. I think that's one of the reasons some people have stayed away, which is a real shame. But one of the things I think we got from COP this year, I hope, at least in this country, was an understanding of the range of different issues that have all got to come together And so the reason this area isn't simple is because the problems are complicated. So there are two things I'd start off by getting people to look at. One is to recognise that you've got stock selection strategies, but you've also got stewardship strategies. And stewardship is all about the fact that equity holders, shareholders are owners of companies, and they can influence the way those companies behave. So there's really those two moving parts that are both relevant. But kind of a structure that I discuss sometimes is saying to people, look, there's four main issues in this whole topic that we're talking about here: environmental, social, governance, and ethical. And there's two main things that you've got to look at. There's another group, the next, if you like, drops down, the approaches that you can take. Now, I've talked about stewardship and I've talked about engagement. Now, stewardship obviously is all about influencing companies, but then you've got the stock selection bit, which can be about a company deciding to avoid stuff, or fund manager deciding to avoid stuff, or taking more positive decisions, saying, no, that's specifically the type of company I'm looking for. So there's different strategies there. And wrapped around all of these things are the fact that we've really got to change the way we lead our lives. Otherwise, we will drive ourselves utterly off a cliff edge. So the two main things we've got to achieve are changing existing companies and growing new companies. And of course, we've got to remember what we're talking about here is investments. So please, everybody, rest assured, none of these funds have the right to survive simply because they've got a nice sounding name or because they do something lovely for society. That sort of thing is called philanthropy or charitable donations. So that is not the investment market. So please, guys, rest assured, we are talking about real investments here.
Absolutely. And we've obviously seen the pace of new issues and launches coming to market accelerate wildly over the past few years, but we still have some fund selectors saying that despite this vast array of products, that there still aren't enough to select from. But what do you have to say about the pace of new issues and launches coming to the market? Like I said, there was a handful a few years ago in the investment trust world. Now there's around 30.
Yeah, so I was just having a look at that. So if you take environmental and social funds, which is what we're talking about, I think on the first 2 days of this, certainly of the funds that we've got listed on Fund Eco Market, only 2 of them are more than 5 years old on the social side. And I'm going to look for my notes. And on the environmental side, only 5 of them are more than 5 years old. So yes, this has been massive. This has exploded recently. What do I say about it generally? It's both amazing and terrifying. On the one hand, it's fantastic because it gives people like me hope who've really, I've put my whole career into this. I haven't really, since being a bona fide adult, actually done anything else other than try to say to people, hello guys, environmental and social issues are relevant to investment. And suddenly all these people are saying, you know what, we've caught up with you, which is great. But there's also a lot of people out there who are creating funds. They don't necessarily understand how things interconnect. They're at a fairly early stage in their journey. And a lot of those people are kind of putting themselves out there as being experts and deeply knowledgeable. And that can be quite scary sometimes. And that's why we're getting greenwash and things, which I'm sure we'll come on to in due course in this conversation. It's not necessarily a bad thing. Everyone's got to start somewhere. So I welcome all these new people in, but they really do need to, before they start criticizing other people's funds, take a little bit of a step back and check what they're doing themselves and understand and take advice on it and talk to people. And there's a lot of people selling a lot of services which are making a great deal of money that being a little bit opportunistic, which is worrying. So the stuff we have on Fund Eco Market is free to use. It's been going 11 years. People can just go in and check what funds do, but we don't really analyze the data terribly much. We're mostly just bringing together information to give people a hub of resource to go to read up on these funds. But we do classify funds into different styles, so you can see, is it focusing on the environment? Is it focusing on social issues? Is it focusing on ethical issues and various others? So yeah, amazing and terrifying, I think is the answer.
Yeah, I think that sums it up perfectly. I mean, yes, we're working in a sort of relatively immature part of the market. As you said, there's only 2 funds that are more than 5 years old. And yes, lots of investors are looking at this for the first time. So what if you wanted to give some sort of tips, what do investors need to be mindful of? So there is lots to talk about greenwashing, and we have seen policymakers and regulators honing in on this, lots of regulations coming from Europe now, and I think it's only going to accelerate after COP. But so yeah, what would you say investors need to be mindful of?
Okay. Oh, excuse me. The first thing that you've got to keep front and center is that if we are going to successfully transition to a future that enables human society to prosper, as we have done for the last, however many hundred and indeed thousands of years, then investors have to be part of that change. This shift will not happen unless people like the guys who are listening today and everybody else in the investment community realizes that these things are interconnected and that they're relevant to investment decisions, and that we've got to start pushing money into those companies that are leading the change, and we've got to put pressure on companies that are today's what we call normal companies. You can call them laggards if you like from an ESG perspective, but it's the way business has been done previously. So that's the first thing. Investors must be part of this, and we have a really important role to play. We can't do it on our own. Regulation, legislation, etc., is moving very, very fast now, and that's a good thing. A lot of people haven't wanted more regulation, but actually, I think we've all come to the conclusion that it's not optional now. So on to greenwash. The more negative side. So firstly, yes, greenwash is real. There are companies that are misleading people. However, I break it down into two types: intentional and unintentional. Now, intentional is, frankly, obviously wrong. People are trying to big up what they do, knowing fully well that they don't. My experience, though, from bringing together information on these funds forever is that, as I said a moment ago, a lot of the time it's unintentional. It's marketing departments that don't understand what other companies are doing. They don't understand how far behind their competitors they are. So they're doing a lot more than they were doing last year or the year before, when they probably weren't doing anything, but they're doing nothing like as much as those people that they think they're competing with. And some of those companies obviously have some very big marketing budgets. So what you've got to do really is to look under the bonnet. I mean, this stuff isn't new. I mean, there's been companies bigging up what they do forever, right? So this is no different than anywhere else. And that's where the regulatory bit comes in. So one of the things we see is that people tend to criticize other funds for being greenwash, and they never really would ever consider that their own funds might be. So that just shows sort of the level of maturity and understanding. Everyone thinks their own strategy is great. So that's just universal. And most of them are, looking at the whites people's eyes, genuinely, they believe they're doing something great, even though they may be way behind others. Another thing to keep in mind is that there's no really sustainable companies. I mean, most companies today still use fossil fuels to power their offices. Some of us have got solar panels, but it's hardly mainstream, hardly everybody yet. So it's always, if you like, shades of green. So be aware there's different strategies, and different funds focus on different things. So don't assume something is greenwash because it's not amazing at environmental issues, when actually they position themselves as being a social fund. So yeah, we've got to move ourselves towards a properly circular economy where we're restoring nature, not destroying it. And there's a lot of change that have to happen. And like you said in the introduction, Natalie, we're really at an early stage. So just look under the bonnet. If you're looking at funds here, we've got this free resource. We don't even ask people to log in, and go direct to fund managers' sites if you want, whatever. Just take a good look at funds before making any decisions.
Yeah, it's really interesting having you talk about that, because we've written a story for ESG Clarity this morning about biodiversity and the number of FTSE 100 companies that have mentioned biodiversity in their annual reports or websites, but then it is just a fleeting mention. There isn't any sort of backup. There aren't any companies looking into how much of an impact they're having on nature. So, and yeah, whether it's intentional or not, there needs to be a lot more the concrete action rather than these fleeting mentions.
Absolutely.
So let's talk a bit about environmental funds, as we are on Environment Day for this conference. Especially in the trust world, they can provide vital funding to new and innovative companies that are providing solutions to climate change. And we're hearing from some of these trusts later on. What can you talk a bit about those trusts, what you've seen, maybe some examples?
Sure. So I'll start by giving you, if you like, an overview of it. So the funds that we classify as being environmental on Fund Eco Market across all product types, we have 67 listed. As I say, most of them are pretty new. So to look at the general areas that they cover, I just kind of went through my list to try and see if I could pull out some themes and trends for you. So you've got the clean energy and the renewable funds. You've got the low carbon funds, which may invest pretty much anywhere, but they're looking for companies with lower carbon footprints. We've got funds that are focusing on climate solutions. And then you've got those which are more niche. So they may be things like water or waste or batteries and storage. So some of them are very similar to what you would see as being a sustainable fund, or go back 10 years, you would have called it an ethical fund with a deep emphasis on environmental issues. So I think those sort of 6 groups are the main sort of areas that we're looking at here. And of course, the other thing that's relevant is the entity level, so the kind of organization that runs it. So if you're a person having a look at these funds, you may favor investing via a large company that's sort of been successful for many years and very sophisticated, or you may fancy someone who is more specialist, who's been, they're probably not brand new, but they may be more like the funds that you're going to hear from today, where the whole organization actually thinks in a particular way and recognizes the risks and opportunities and the issues around environmental challenges that we face, and just embed it into all, if not, well, or most, if not all of their funds. So I think those are the pointers to look at: the type of organization, the theme that the fund is looking at, and yeah, I think we could split them down further. Obviously there's the different product types, but really that's going to depend. Well, you'll be hearing more from those types of fund managers today, but broadly speaking, a lot of them are equities, some are passives, mostly they're not. Mostly they're actively managed funds that we have listed, and yeah, a real variety. So if you're trying to build a portfolio around this, you can do it now. Those people that say there aren't enough funds, I mean, honestly, there's always going to be people knocking this area. Most fund managers most portfolio managers can manage a portfolio with 67 funds, especially as we've got hundreds of sustainability themed funds that in many ways, a lot of those have got massive overlap with these funds. So, I don't buy those arguments at all.
Yeah, absolutely. If any of the listeners have a question for Julia, please put that in the chat, and I was trying to keep an eye on just now. Yes, so I can pose them to Julia for you. So moving onto sort of social side, I know that this is a topic for tomorrow, but I wanted to ask you about social impact funds. We do have some really big names coming to the investment trust market on this, sort of institutions working with social housing groups or big society capital. Are you pleased to see things like that?
Oh, for sure. They're brilliant in many ways. Those types of funds where they're really targeting specific problems, they're the icing on the cake for many portfolios. They're deeply necessary and extremely welcome. But social issues are quite, they can be quite emotive, because a lot of people have got a real personal connection to them. So people can get quite upset if something isn't absolutely perfect. So I guess I'd always warn people to be aware of, there are no perfect companies. As I was saying first off, there will always be, something. If you know someone who works for a company, there's always going to be some gripe that they've got. But again, you've got to look under the bonnet and see what they're doing. And again, I tried to split this group into their sort of categories, and the ones I came up with were, so there's healthcare generally, and then there's one that focuses on old age, so golden age. There's ones that focus on gender. There's ones that focus on social housing, and there's social bond funds, which are really broad across the piece, like the Threadneedle Fund, which is one of the older funds in this area. So there is quite a variety. So again, if this is something people are interested in, have a look under the bonnet, check what you're going for, because a fund that's really looking to pick up those companies that have got a better balance of men and women on their board or their employees and etc. It's going to be very different from something doing social housing. I mean, they're just not designed to do the same thing. So to have a sensible number of labels that people can work with, we give them the label social, but they're massively diverse. So yeah, don't muddle them up with one another. You've got to recognise that they are quite different things.
Absolutely. Thank you. And engagement is a big topic at the moment, with groups debating about whether they need to completely divest from companies that are the highest emitters, are damaging the environment, or engaging with them to ensure they are part of the sustainable transition and take them with us on this journey. Where do you stand on that, and what would you define as good governance on this topic?
Yeah, okay, so this is a big one, because people often think stewardship equals greenwash. It doesn't. It is absolutely crucial that the people who own companies, the people that, the chief execs and whoever of any company effectively report through to their shareholders that they're reporting, well, that they're making sure that that message is communicated downwards, that environmental and social stuff now matters. Now, regulation is going to force them to some extent. You've got the new FRC code came in last year, encouraging shareholders to vote and to be more active in this kind of thing. But so first off, don't confuse stewardship with greenwash. It isn't. I wrote a piece on this recently, and the analogy I used, so for a magazine, Money Facts, and I called it stick or twist, just to try and get people to understand in their minds, you know, the two different strategies. So you can stick with a company and engage and stay involved and put pressure on the directors of a company to change what they're doing. And you've got a seat at the table. And if you gang together with other shareholders, working with those coalitions that we've had, things like IGCC, Climate Action 100 Plus, and now GFANS, and all these various groups coming along to say, no, we're going to work together. We're going to put pressure on these companies, and we're going to encourage these companies to change, because frankly, they've got to either change or go out of business. And then the twist bit is where you can go, okay, I'm going to chuck them out of the portfolio. I don't want anything to do with them anymore. They don't meet my criteria. Now, to my mind, it depends on the type of fund, you know, which one of those you should be favouring. So typically funds that are positioning themselves as being aware of environmental or social and sustainability issues, typically those funds have avoided the most contentious companies because people rightly expect them to invest in leaders, which is absolutely right. But we've seen a lot more funds recently come into being more of a tilt, where they're saying, no, we're overweight in the better companies and we're underweight in the worst companies, but we're going to engage with them. Now, I think that's a bit confusing for clients personally. However, there is a logic to it. But either way, I would say, across the board, all company assets must be used to drive change in companies, because we simply cannot wait for the newer innovators to get big enough to, if you like, take in their place. So to accelerate this, my conclusion in that article was we need a lot more stick and a lot more twist. So we need a lot of both. So absolutely crucial that stewardship is encouraged, and the regulators, all the new regulations that's coming through from the FCA and others, they are now referencing stewardship activity, and we're getting a more joined up approach, which is saying that, both strategies are appropriate, but you've got to disclose what you're doing and make sure it's very clear to your clients so they understand. And honestly, most fund managers are not great at communicating their stewardship activity with individual investors on the retail side, whereas on the institutional side, they've done loads of that for years. So institutional investors understand this stuff, whereas retail investors who've not had very much information of that kind tend to just assume it's greenwash, and it's not. It's very, very real.
Yeah, it's very tricky, isn't it? And it's obviously goes down to the client preference, but also we should be educating clients about that point. On there will be investors that say, I don't want coal in my portfolio, but if everybody said that, the implications on the markets, the employment, supply chains will be far reaching. So it's working with those companies and ensuring they're part of the renewable transition. Yeah,
but they don't necessarily have to sit in a fund that's labelled as being environmental. I mean, to me,
no, that is true.
Coal in particular, that sits outside. And you're right. And the point exactly you're making there is, you may have an investor that's really, really caring and with a massive research team and really good at actively voting their shares and putting companies under pressure. Once they catapult, the senior management of the team probably goes, yeah, fantastic, they've gone, and someone else will pick up the shares that won't care. And that that doesn't really help. Again, it comes down to where the assets sit.
Yeah, I'm sure we could be talking about that one for a long time.
I speak about that really a lot, and it is a fascinating, complex area, and different people want to put the line in different places. But to me, I just like to primarily get the principle across that both strategies are entirely valid, but they're going to suit different people and different parts of their portfolio, and we need a lot more of both.
Okay, great. We have been most recently went to COP26. What were your key takeaways, and what do you think will be the impact on the investment landscape?
Okay, so firstly, great question. My key takeaway from my personal experience there, and I was only up there for 2 nights, was that it was just lovely to have all these people around me that felt like I do about these things.
Yeah.
Having spent, so much of my career feeling like, the slightly strange one that people were friendly to, but were kind of wondering where on earth you were coming from. And the fact that the people were talking about so many different things, and you realise that the penny is gradually dropping, that this is a whole mosaic, if you like, of issues that we've got to solve together. We can't just say, okay, let's put in a piece of legislation on climate change and bang, all sorted. It's not. I mean, there are social issues, obviously, and the governance, the way it's all managed is really important too. So, I like the fact that people shared my aims with regards to what's happened now. There were lots of announcements on the finance day. Obviously, that was what I paid most attention to. There's a whole raft of new stuff around SDR, so sustainability related disclosure. And there's the FCA set up this group called DLAG, which is Disclosures and Labels Advisory Group, which I'm going to be on, which I am on. It meets the first time in a couple of weeks' time. And we are going to try and crack this stuff around labelling, getting people to understand funds better so we can build confidence in the market, because we've got to, if it's going to expand, people have got to feel that they're comfortable understanding what's what. With a lot of people then are talking about, well, was it a success? Well, I think the answer has got to be something like it was and it wasn't, because we didn't get China and India agreeing to phase out coal, and saying that putting that absolutely to bed, which is what must happen at some point, preferably about 5 years ago, but that didn't happen, so let's keep trying. So yeah, the landscape is shifting really fast. I think what happened in this country anyway, and I'm not so sure it hit so hard overseas, because we hosted COP, so it's been very obvious in the UK, but certainly in the UK, I think the penny has dropped that this stuff is really real. And you are getting people who would never have talked about it sounding really scared about climate change.
Yeah.
And I, a little bit of me, talking to grandparents and whatever, saying, I've been saying this for 30 years, this stuff was always going to hit. So don't be surprised, but we've got to act. I mean, obviously not a lot most people's grandparents can do about it, but with their money, with investments, obviously you can put pressure on companies to shift in the right way. It does, it opens up some really interesting issues. There's with it becoming so big, certainly there's things like, the whole tax regime. We're talking about systemic change here. We're talking about shifting the way the way companies operate, the way governments run. This is massive, and I think one of the successes of COP was that realization of how enormous this all is, and it went the right direction for sure. So broadly speaking, we should be happy with what happened, but they're absolutely right to be saying they've got to keep momentum up. And
yes,
Sharm el Sheikh, I'd quite like to go back to Sharm el Sheikh, really haven't kids, but no, I mean, I probably wouldn't, because it doesn't make sense. But anyway, I'm not sure if I've missed anything important there that you wanted to touch on.
No, I was just going to agree with you that I feel like the conversations I've had with my friends and family, my peers, have really changed since COP26, because it's been sort of on the news and they really understand it. And some of the words, well, God, it is really quite scary, isn't it? So, but then, and yeah, it depends who you speak to and whether it was successful or not. So I think some of the financial industry would be like, oh yes, we're pleased with the announcements, and then I've had some very angry press releases from NGOs in my inbox. So yeah, it very much depends who you speak to.
It really does. It's split people, hasn't it?
Yes, it has. Okay, so we have had some questions come in, which is great. And I'm glad someone's asked this one. It's about performance. Am I giving up some of my returns to go green in my investments?
Okay, let's start off with some caveats, which is obviously I'm not a financial advisor, I can't give advice, etc., and I don't know who asked the question, but broadly speaking, no, of course not, because the environment is really important. We know we can't carry on the way that we've been doing, because we will drive ourselves over a cliff edge. Assets will become stranded. Oil companies won't be able to pull the oil out of the ground, etc. To me, obviously the quality of individual fund managers and whatever varies. But generally, no, it's going to enhance your portfolio, because you're talking about fund managers that are considering issues that other people haven't paid a whole load of attention to. So that's an entirely good thing. Obviously, if you're going to go into an environmental fund that just focuses on one particular area, say water or whatever, and that sector happens not to do particularly well, that's a different issue entirely. But performance-wise, generally, you've got to say that we're understanding risks and opportunities in this area that many other people have overlooked for far too long because they've had their noses to the grindstone just munching through figures rather than looking at real life issues and how society needs to change. And those companies that have got good environmental strategies are aligned to where we need to get to in the future, or at least aligning to that. Therefore, they will be better placed to succeed going forwards.
Yeah, I think we just need to look at the consumer patterns, don't we? The people are looking where can they which product can they buy which is more environmentally friendly. That will be reflected in portfolios, won't it?
Absolutely. So consumer choice, ahead of regulation.
Yes.
Not too reliant on finite resources that are being depleted because they found better ways of doing things, perhaps recycling more and coming up with making products that don't have such heavy footprints. There's so many reasons to assume these companies, or to expect all other things being equal, get nice economist sort of phrase in there, and all other things never are equal, but broadly speaking they should do better.
Okay, this probably takes us quite nicely on to the next question. Are the big companies really listening? Another anonymous attendee has posted that.
Are the big companies really listening? That's a really good question. I would say I think they are. I think they've got to get the message from their shareholders that their shareholders care, because otherwise they will keep finding ways of scouting around the outside and undercutting their competitors. But no, generally speaking, I would say big companies have got the message. They understand that things need to change. Are they suddenly staffed with people that understand environmental issues really well? No, they're not. They're going to have to learn from one another. They're going to have to be directed by regulation and consumer preferences. Consumers are going to have to vote with their feet and voice their opinions more. I mean, even on the investment side, I talk with some of the world's biggest investors, and and when they're being honest, no, I won't say who it was saying to me the other day, they were just saying, we are having to learn from our clients. We don't know this stuff.
Oh wow. So
yeah, that's the reality of it, that suddenly everyone doesn't suddenly know the answers. But if people communicate it to them, don't underestimate the power of getting the message through to companies in whatever way you take, partly purchasing, partly going direct to right to their PR people, right to their CEO, whatever. But yes, they're better than they were generally, but it's always slightly dangerous to generalize.
Yes. Okay, another question is, what services are there, well-regarded names welcome, to help small firms monitor their environmental performance and other metrics over time?
Okay, so are we talking about investment funds? I don't know if an anonymous person wants to, so I presume we're talking about investment funds here, but there's a lot of people who are providing data services in this area now. You've obviously got Morningstar, MSCI, you've got, De facto are now doing a bit in it. Dynamic Planner are starting to do bits. Square Mile obviously have got a rating system. We classify funds into styles. The problem with it though is that the primary data a lot of the time still isn't there, and the FCA is concerned that people are basing a lot of decisions on data that companies themselves are not able to collect. So there's lots of sort of proxy, by proxy decision making. You make assumptions about a company. If someone does this, chances are they would have scored high, medium and low on something. So the problem is investors haven't been asking for this stuff historically, therefore the services didn't exist historically. But some of the big boys have, MSCI hoovered up lots of companies. Morningstar obviously bought Sustainalytics, so they've been buying into more specialist firms. But one of the things that's worth always underlining here, a lot of people are really critical of the market, that these rating and research agencies, their findings don't line up. They expect them to correlate perfectly. And I would say in many ways that's probably a good thing, because this market is so massive and so complex. You know, if they were both saying they were looking at identical things and then they didn't correlate, that would be a problem.
Yeah.
But when you look at the methodologies and you realize actually they're looking at slightly different things. So, you know, a lot of the rating agencies have really gone to town on governance. So you can have, you know, an oil company or a coal mining company that people will say has got phenomenal governance, and therefore they give it a good score. Now, to my mind, that's complete and utter trash. I mean, that just makes no sense whatsoever. But you know, they've been brought up to believe that governance is the be all end all. So
yeah, I was just going to say, is that because it's easier to measure rather than the E and the S factors?
Well, it's also a legacy thing. So the institutional market started looking at governance before E and S issues, because if you go back 10 years, E and S was seen as being, you know, fluffy, irrelevant, and for slightly weird people to worry about. Whereas governance was like, yes, this is a management issue, and you can start quantifying things, and you can have serious grown-up conversations with, you know, how do you manage this and the other risk, and then the metrics started to evolve in governance before they did on the environmental and social side. Whereas to me, I'd say these things are completely interconnected. You know, environmental issues affect people, and the way a company manages environmental and social issues, we call it governance, but you know, it's the governance of environmental and social stuff, so you can't really separate the three out. But I would just say on the investment side in particular, you know, the governance side is more advanced, but it has led to some really weird answers, because a lot of the time I've been answering back when people comment on that sort of thing, saying it's not just how a company's run, it's what they actually do that matters, because that's what has the environmental footprint or the social impact. So you've really got to look at all of them, whereas some will focus more on what a company does, and they will be misaligned to others that focus on governance. So understand the methodology. If you're looking at research, this kind of stuff, you know, try and understand what it is. And these guys do not make it easy to find out. They really don't. I mean, my business is small, but that means that I can do what I believe in, and we just put all the information out there that just explains, you know, just describes, well, we classify it as this if we think such and such, and I'll put blogs out to say what people are looking at most regularly, to tell people what other people are interested in, and a lot of these, so the sort of methodologies and everything, I think with regulatory changes, I think we'll see a lot more pressure for that stuff to be out in the public domain. Whether or not they'll use words that anyone can understand is a different topic. They probably won't to start with, but in due course they will, I would say, as it matures.
Yeah, more acronym soup.
Yeah, indeed, we all love it, right? but look, any complicated subject has got acronyms and has got phrases they have to use. So yeah, we tend to beat ourselves up on that really a lot in this area. And the more I've thought about them over the years, the more I thought, hang on, there's no area that's of any real importance that hasn't got their own language they have to use, because you've got to communicate somehow. So yeah,
that's a very good point. We kind of touched on this earlier, but another question we have is the protesters were clearly not impressed with what was said at COP26. Do you think it is a turning point?
Well, in the UK, I think the penny has really dropped. I think we've hit a turning point in the UK. The evidence would suggest that China and India are not in the same place, although China has led on very many environmental issues and causes. Obviously, they manufacture most of the solar panels that people buy now, that kind of thing. So they've really invested in the area, and you know, they face their own challenges. You know, social issues kick in when you say, well, okay, so we're not going to be able to power things anymore. Well, that's not going to work for them. They've got to find their way of transitioning. I think it's really important that protesters, etc., get their message across that we have not gone far enough, because we are not. We're just, you know, we're tickling the underbelly of environmental challenges at the moment. We've got to get to grips with it and really go a whole lot further. However, we are in a way better place than we were in, you know, a few years ago. So, you know, things have moved forwards, but protesters are right to be annoyed, because we've still got a lot further to go.
I mean, surely it's a positive that China and India are in these conversations. I mean, that wouldn't have been the case a while ago, wouldn't it?
Well, India less so, but China actually has been very involved in this area for a long time. when I was involved with the Friends of Provident Stewardship Funds, there were people there. One of the external committee reference guys was Crispin Tickell, who was Margaret Thatcher's advisor on environmental issues, and he was always in China. He was regularly in China, and he was saying to us at that time, so this is 25 years ago, saying, do not underestimate China. They get it. They are moving in the right direction. It's a massive country. They are going to take time. And boy, they took obviously a massive share of the solar market. But managing their own issues in-house and how they're going to make that transition, it was really hard for a country like that. That said, they've got to move so much faster than they've agreed to. There's no doubt. But yeah, India, obviously more complicated issues there, I guess, more poverty, more social issues to consider. But countries like that, they don't benefit from having a load of pollution. They don't benefit from having companies that are using old technology when everyone else is moving to new technologies. So I'm sure they will shift, and they obviously will make progress, but not at the speed that we want them to, I guess.
Yeah. Sorry, I'm just throwing you other questions out at you now. But do you think the I mean, like you said, they China do seem they get it. The penny has dropped in the UK. Do you think that the pace is slow because it is just very, very complex and we haven't figured it out properly yet, or is there some resistance elsewhere?
I suspect there's elements of both. So I mean, the US is an example, isn't it? Which is that clearly the political backdrop there made it really hard for companies to do most. So you get massive divide if you're looking at funds between what the US-based funds do and what the European-based funds do. I mean, the European-based funds are way ahead because they haven't had 5 years of politicians telling them that climate change is fake news, for example. So they're, they will have people still pushing back there, and that's going to take a while to work its way through the system, I would say. But the scientists really the science hasn't really changed in 25 years.
Yeah,
it's just they've just found ways of stopping being bullied so much by the oil companies in particular, so that they're allowed to speak their minds, and obviously improved and refined and expanded the database that they're, or the bank of information that they're all working from. So the information has been solid for a really long time. A lot of people have been told that it was specifically wrong, and for them to make that switch is a massive jump. Yeah, so I think elements of both, I would say, Natalie.
Great. Okay, well, we've got sort of a minute and a half left. I just wanted to ask you, do you look ahead sort of the next year or two, what are you most excited about for our part of the industry?
Okay, this is going to sound very, very strange, but I think probably regulatory change. Because we've tried to get this all working with free markets and appealing to people's intelligence to say this stuff is relevant from an investment perspective and for the future that you and your kids will live in, and we got so far with that, but we're never going to get really over the line getting everyone on board and lined up and making sensible decisions that are desperately needed, like stopping people investing in coal companies. I'm not saying that has to happen instantaneously, but we've got to stop coal companies opening new coal-fired stations, etc. That we've got to move away from that, and I really think it's only regulation that will change that. And once some countries start doing that, I think others will follow. So I'm really excited about the stuff we're doing with the FCA. I've been talking with them for a long time, but if we can get financial services people, investors, etc., to really walk the talk and understand it and understand that balance between stewardship and divestment, and use those tools in a clever way because they've been told they've got to, rather than just assuming, wanting them to appeal to those nice ones amongst them, we can change things really fast.
Well, that does sound exciting. Well, great. Thank you so much, Julia. I've really enjoyed our chat. I could have carried on for a lot longer, but yes, thank you very much. I'll hand back over to James now.
Pleasure. Thank you.
Thank you both. That was really interesting. So
security